Good evening and welcome to this webinar on navigating the market volatility. Uh, it's definitely been, a difficult time for all of us. Market volatility that we've probably not seen in the past at this speed. So it's definitely we thought that it's a good time for us to reach out to our clients and understand what their queries and concerns were with respect to the market, and see if we could give a few inputs and perspectives so that one can navigate the market volatility a lot better. Uh, Before we start off, I'll just give you a brief of what we plan to do today. We plan to talk about what is the impact of the COVID-19 on global businesses, what is the impact on Indian businesses, and it's impacting markets, and probably it's going to impact our lives as well. The economic outlook 2020 and beyond, and also how do you navigate the volatility. Before I got on the webinar, I thought, I asked a few of my clients and said, this is what I'm going to do. And so some of the content that I have here and what I'm going to talk is a little bit to do after taking feedback and input from people as to sort of what they would like to hear. And I plan to run this over about 20-25 minutes in terms of my presentation. Subsequently, I would invite questions. The response has been overwhelming, and thank you for it. And because of that, to make it a little more systematic, we have requested that your queries are sent to jude@righthorizons.com, and also the mobile number also is given. So please feel free to ask your queries anytime in between as well. Once one is through, I will also take the key questions that have come out individually. And if we are not able to complete it, I'm hoping to complete in about 45 minutes. And if you're not able to complete that, then we will end up sending it to all of the participants by mail subsequently for any queries that are not been answered. And also, if there are anything specific individual queries, we invite you to come and discuss it with us. Our team is happy to spend time in this period, and to just do feel free to get back to them, because beyond a point, generic sessions have a certain value, but subsequently it gets back to what is the impact for me with respect to my portfolio and stuff. So thank you once again for joining. And I start off by discussing about what are the global business impacts. Okay, and clearly there's it's come from a completely unexpected quarter, and it's come in a form which we don't have too much of precedence. We definitely are grappling with the impacts. Of course, in itself, the virus may not have had a direct impact, but what it has done is, it's also typically such events create ripple impacts, and especially when you're looking at from the financial and the economic side, the ripple impacts can be even worse than the core reason why it started off. And we could see that with, for example, US markets fell very sharply when oil prices came off, thanks to demand coming off from China, as well as the OPEC not being able to come to a conclusion. So the reason for that again is that the US today is the largest producer of oil. So many of their large corporates get impacted adversely, and then people start looking at, okay, what are the subsequent impacts? And now there's some bit of fear around, is there liquidity enough? There have been monetary easing measures that have sort of come in, there's a lot of fear around, whether the US, which has been almost like in a 10-year plus bull run, whether it will see get into a recession. Clearly, global growth will fall because of this. Okay, but maybe we need to see how long the impact lasts, and possibly, hopefully, the ripple impacts are not too large going forward. Now coming back to what is the monetary impact and where do we expect the impacts to be larger? Clearly, the European Union is taking the biggest brunt, also because I think their population are aging, and we've seen a lot of fatalities much higher than the rest. Maybe initially they took it a little bit lightly, and the virus spread at an exponential rate. So the European Union definitely is going to bear the brunt, and the US as well is likely to get significantly impacted, and possibly that is sort of the bigger concern for markets, because if markets take a downturn and say the US comes off, then the ripple impact that happens is investors become conservative, and for no other reason but flight to safety, they may end up pulling out from emerging markets. And that's probably why you would see that a lot of the emerging markets like India, which have not been, say, as impacted with the COVID, is today seeing very, very large falls in its markets. So this is definitely a point that is not just localized. There is a concern that this will impact the global economy, and the question is how much. Coming back to India, the Indian businesses, markets, and life. I think for a lot of us today, I think working from home. In fact, we also did provide an option to our team to work from home, and so for a lot of us, actually, life has changed. It's probably a message for us to take it easy. I think spend time with the family. So this is a great opportunity to do that. But coming back to the business impact, clearly markets have seen a very, very large fall, and this is a chart as of yesterday. Of course, intraday today, we did correct more and then sort of pull back. So so this is clearly a 30%, 31% fall from the peak. And if you look at on an intraday basis, the fall was almost like 35%, and all of it in a very linear straight line down, and in a really short period, possibly the fastest fall that we have seen in the past. For Indian markets, the added problem was the Yes Bank collapse, the fears of bank defaults. The Yes Bank collapse did shake up a lot of people from saying that is my bank safe, and that has had its impacts on the stocks of all the banks, and irrespective of quality, many of them have fallen. I don't remember the last time I saw HDFC Bank fall 10% in a single day. So that is a bit of an impact that we've seen. The question is, how long will it last? Clearly, early trends indicate, the quarter, the last quarter is going to be okay, was sort of okay, and this quarter ending March 31st is going to be reasonably impacted. Of course, there are some sectors, which have benefited, like essentials, and possibly they'll see a spike because of some bit of desperate buying to stock up your houses. Okay, and so those are maybe one of few places where you may see some bit of safety, but definitely one can expect that you will find this period is not going to be a great period from the economic standpoint and how results come out. But the point to be also noted that is markets have, I think, discounted a bad quarter this quarter. The question is, how much more and how longer is it? And that is actually what is spooking markets, and possibly discounted a slightly longer period. And if you go back and see, markets typically discount worse than what actually happens when there's uncertainty, because market hates uncertainty. And there's also some bit of loss of productivity. Like I spoke of, we need to rework both businesses and our own personal lives, based on this particular scenario. Now coming back to the areas of impact on India, one is tactically, we think the direct impact is sort of mildly negative. Okay, there will be productivity losses, job losses, temporary income, stoppages will be there, and also the cost of the health hazards. I think also the emotional cost, which I think a lot of us discount, because there's a lot of fear that has come in, and possibly it's the stress also linked to that. So those are impacts which may not be economic, but it impacts the emotional, takes an emotional toll. And clearly there will also be fiscal stress now, for people who have to make payments, let's say loans to be repaid, etc., etc. There's going to be some bit of disruptions, because even just the ability to get teams to work seamlessly and achieve the same levels of productivity. These other impacts are actually of deglobalization, because supply chains have got disrupted from countries like China. Even though production has started, I think many did not accept production coming from, and some of the ports were closed, etc., etc. So the supplementary impacts were there. In terms of sectors which have adverse impact, clearly airlines, tourism, travel, hospitality, leisure and dining, merchandise, export-oriented, consumer discretionary. A lot of these have sort of sectors which have got impacted. What is it that has not had an impact, or maybe have had a lesser impact, is the FMCG, pharmaceuticals, and some of them actually, like I mentioned, may actually benefit from it. Of course, the pharmaceutical may depend on, if they have drugs in a closer area to what the treatment is, then they will benefit from it. Infrastructure maybe, and IT services, possibly no impact, no direct impact, but impacts would come in, from clients being in shutdown and not working to their full capacity, etc. Of course, the good thing is today the ability to work from home is very high in this sector. So I think that has been a significant cushion for us. Now, what is it that we look at, in terms of the economic outlook 2020 and beyond? I think there are short-term outlooks. The thing is, maybe the GDP, people are estimating, can come down by up to 1%. Okay, and this is not good news for India, because we're already at lows. So this is probably also get us into a definition where we are in recession, because the government was saying, yeah, if you go by the strict definition, we are not in recession yet, but possibly this will end up getting us into recession even by the definition of the recession. And redrawing of business metrics, workplace policies, etc., adding costs, loss of productivity, and of course lower incomes. Because I think already in certain sectors like the airlines, there's a very large scale job losses, and some of them of course have very low fixed salaries, and most of it is based on the hours they actually fly. So there is definitely going to be impacts there. The impacts also come down to maybe the not so great economically sections, and who sort of are dependent on daily wages and stuff. It's really going to be, I think, painful for them, including vendors, etc. So that's a concern, and I guess this is why one hopes that the direct impact is not too high. Okay, the second is about what's the medium term outlook. I think at least as of now, if you just go by the direct impacts, its data shows us that it has a certain cycle and there's a bell curve to how infections happen. And we also have experience from China. I think even some of the other countries who are not doing great, like Italy and South Korea, beginning to see plateauing of infections. So the impact, directly may not be high. One is just concerned about, whether there will be indirect impacts, because an example is, say, disruptions on demand, and we can see that with oil as an example, right? So, and if you see some of those impacts, then it could impact a number of countries who produce oil and the industries associated with it. And I'm just giving an example of a sector and how it could have a ripple effect. Now that sector again borrows from banks, and the banks would the repayments would get impacted, and you may have indirect impacts from there. So one need to see the longer the core problem lasts, I think the greater the issue that we have. And a few good things is global inflation is low, okay, and for India specifically, lower oil prices is great news, and for the government. And the good part is, at times like this, the government typically doesn't have money to also spend, because the tax collections are lower. So something like impact on lower oil prices can really benefit the government in being able to utilize some of this money to spend on areas which are required without impacting fiscal deficit. In the medium term to long term, we think that debt will also deliver stronger returns. Of course, there are if there are crazy disruptions on financial institutions, and like there are fears today, that may have indirect impacts, and we may see further spikes up in interest rates in the short run. But one would believe that the RBI should come in and sort of lower interest rates. Now, this has been a query that many people have come back and said, based on past experience, what is it that you have seen in the past? And because I think the past does teach a lot of lessons, and I've seen, I think, all of these in my investing lifetime, and I think clearly, every time markets will get you to a panic situation, and that is why you see the overall index itself falling 30% or more. Most of these are falls. We've looked at falls which are, say, 25% or higher, and you will find that the correction periods have been anywhere between, say, 3 to 14 months, leaving out the outliers. Okay, and so actually the falls have been pretty sharp, much sharper than the rise in markets, because I think fear is a greater emotion, and that's where, and markets, like I said, hate uncertainty, and they always exceed on the negative side as well. So one point is, one takeaway from this is that the periods of falls have typically between you can expect 8 to 10 months plus or minus. Okay, and if things are better, it's all over within 3 to 5 months. So one is hoping that that's what is the scenario out here. However, it may not be in this chart, but broadly the falls are never in one single line. So right now we've seen a very single linear fall. So even if there's a larger fall, it's likely that things spike up before it goes down. The other aspect and the interesting part of all of this is, and which is why I think it's important for us to keep calm through these times, is that markets come back quickly from these negative scenarios. And if you look at even within 1 year, you will find that most of the falls have been the markets have completely recovered a significant part of the fall. And of course, you need to keep in mind that when markets fall from a peak, right, the percentage is lower. So let me give an example. If let's say an index grows from 100 to 200, the rise is 100%. But if I see a 50% fall on 200, actually that's 100 points. So I've got back to square one. So which is why you'll find that the numbers on the right hand side, even though they are strong, if you look at it from a fall, it's not as high as the percentage. But clearly, past data shows that the recovery is always a V-shaped recovery, and this also brings us back to the point where, if I plan investing strategy, what do I do? Because typically we see a V-shaped recovery, and these periods are reasonably short, and the ideal thing is to take safety and just sit back and let it be. And again, maybe I would think that let me give an example which is slightly divergent, and most of us, right, when what do we do when let's say real estate prices are down? We would say, okay, let me not sell my property now if I was wanting to sell it. Let me sell it when, say, prices come back. So I think that is broadly the situation that you need to look at here. Of course, in real estate, maybe the cycles are much longer, but in equity markets, from what we can see, even the 1 year cycle is a good cycle to see a recovery of a significant part of the downside. Now, let me also, I just wanted to do one quick one on from China and COVID infection, etc. The direct impact, if you see, the markets here did fall. So from Jan 14th onwards, it had a low on the 4th of Feb and recovered most of the fall by the 5th of March. So like I'm saying, in itself, I believe China does give us an example to us that the direct impacts may not be as long in terms of time frame, and I think it also gives us a bit of a perspective. I think a lot of us are really concerned about the impacts of this on our health and how it's going to disrupt. I think the concern may not be as much the direct impacts as the indirect, say, economic and other impacts. So going forward, what do we expect? We think RBI is going to infuse liquidity in the system. I believe the government will also come back with a number of measures. At times like these, it needs to come and bring back confidence. Today, we have the Prime Minister going to address the nation as well, and markets do that and force people to come back and take steps. And one believes that we may see a lot of benefits coming back in an attempt to try and calm nerves of the markets. I think the way I look at it, one important point that the government needs to address, that was specifically for India, is measures around the banking system, and I think both RBI and the government sort of need to work well to ensure that it doesn't spread, because if it does, then those impacts can be very severe. And this may be a bit of a local scenario. So this is something that one hopes that the government does take measures in time. So far, one believes that RBI has worked very, very swiftly, and I think the way it handled the Yes Bank and I think was the best win-win. I think even for SBI in the long run, it will probably make money on whatever the investment it made. Okay, but bringing SBI in and sort of cooling things down was important. But of course, the question is, SBI cannot keep on doing this again and again. So I think measures to bring a bit of safety and stability, I think, are sort of important. Okay, the impact on, I think we'll have to wait and watch how long, some of these disruptions last, because it is definitely uncertain, even though maybe we have one or two countries where the data points where, things come down in terms of infections. But like I said, the question is on what are the ripple effects. Okay, the good part is that this would lead to sort of lower interest rates after maybe some bit of volatility in the short run, and lower interest rates is sort of sets the base for a larger consumption growth story. And let me again give you an example. See, most people, will, when interest rates go up, will say, okay, let me not buy a house now. Interest rates are at, say, 9.5%, 10%. Okay, so let me not buy my house now. Let me postpone it. Okay, and similarly, maybe you're buying up something which is not essential, like car, etc. You may push it back when interest rates are higher. But once say interest rates sort of come down, whole new growth will come in terms of people wanting to buy homes for themselves and first time buyers. Interest rates does sort of spur consumption, and one of the key reasons for this decade-long bull run, say in the US, has been weak interest rates, and that is something that I believe that is a great thing for India, because it also makes India much more competitive. And again, let me give an example. Say if somebody is building up a factory out here, maybe he's putting even 500,000 crores. Now, one is, of course, the time that it takes in India typically to set up a factory with all its approvals, etc., is longer. The second is that they are at a great disadvantage, because when they borrow, say they borrow at say 10-11%, whereas somebody who sets up a factory elsewhere, let's say in China or the US or any other, most of the emerging markets, where if interest rates are lower, then the interest rates are a clear saving for them. And possibly in China, you may save 50% of the interest rate that you pay in India, and you become that much more competitive. So I think in the long run, it makes it better for us. Of course, the downside for investors is that weak interest rates will hurt us, because we are used to the typical bank deposit. We're used to fixed income instruments, and like in the US, people don't have a choice. Even if you are planning for retirement, you cannot do it in debt instruments. Okay, so that is something I think as India matures, that will also come in. But whether we like it or not, that's a trend which is likely to evolve. And I believe that the next decade is a decade where India will do relatively well, because you've seen structurally inflation has come down, and so has interest rates, because earlier we had a very high interest rate regime. So this is something which is sort of an important consideration, and which is why I believe that the next decade is going to be a decade of reasonable growth for India. So in the long run, I'm extremely bullish on equities and Indian growth, because number of measures like GST, etc., will now start coming in over the longer run, and also the benefits of lower interest rates. Medium term, of course, and short term, I think we need to keep our eyes and ears open. So what is it that one needs to do to sort of navigate the volatility? I think first we have to have a very strong foundation, and I thought, let me actually give you a bit of a framework, how to evaluate your situation, and how maybe you can take decisions on what to do based on that. I think it's important to look at sort of a 3x3 matrix, saying that sort of where do you stand today? Do I stand in a very leveraged environment? I mean, do I have a lot of loans? Do I have by leverage? I could also mean that it could mean that you have certain needs that are coming up, okay, and there are outflows that are coming up, and I may not have liquidity for that. Do I have a sort of a balanced portfolio? And by balance, I also mean that there are some things which may even be in longer term assets. It may be in PF and other things which sort of take care of your longer term needs. Okay, and the third is am I a very conservative? Is my portfolio very conservative in terms of significantly being debt oriented? So that is one frame to look at it, and the second frame is to look at what is my risk appetite. Okay, so can I am I happy to take advantage of market scenarios? Can I take a little higher risk for delivering a higher return? Okay, do I want to be sort of moderate? Okay, I want to and I think, like, for most people I've seen, they want to say, okay, I don't want some great return, but I don't want some great losses either. So I want to play a sort of a moderate risk. And there are some of us who want to be
the other extreme of saying that, what, in terms of risk appetite, I want to be very, very safe. So it's sort of a combination between the two, and based on where you stand, because let's say if I stand in a highly leveraged environment, then I think it's time to, you cannot take advantage of the current situation. I think one needs to get back to the drawing boards and see, how do you meet the particular requirement that you have, and how do I ensure that I'm able to repay my loans, etc., etc. So that is one perspective. And if I look at the other extreme, if my portfolio is significantly debt for various reasons, okay, then this is a time that I can definitely take advantage of equity market volatility, and like we've seen, studying past data, so markets typically come back and end up doing well in a year from where the volatility lasts. Okay, and so that is something which one can do, and I think based on this matrix, I think you can see where you stand, and accordingly see what level of risk you can take, how much you can leverage, the market fall to deliver superior returns for yourself. Okay, and I think that each of us are sort of unique. I think we'll fall into one of those categories. So we need to look at it as per what is sort of appropriate for us. But just from a broader perspective, I think equities are volatile in the short term, but these are times to actually keep calm, and one has the past to sort of draw back from. And the second aspect is, once markets have fallen, and if I am investing it in a diversified manner, then averaging actually helps also recover losses. Now, the point to keep in mind is, I think, getting into concentrated bets, because you may see at such times the trends may start turning, but it's very important to keep it diversified. And the second aspect is, it's impossible to predict what is the exact bottom, which is why it's good to sort of phase out some of the investments that we make, and rather than sort of put it in a lump sum. Systematic transfers are a great option to look at. So I think if we can be aggressive to that. So when recently we did suggest a bit of a movement for clients who have say debt above a certain level into equity, systematic transfers is one recommendation that we sort of sent out, and of course where people do have the ability and risk appetite, the lump sums also can be done sort of in a bit of a phased manner. I think one very, very important thing is, as far as possible, unless you see disruptions in income, I think you should not be stopping SIPs. One is, you may see that the past returns is very poor, but actually that's the whole reason for investing in the systematic investment, and that is what actually will get you back your returns in the long run. So SIPs are definitely not to be stopped, and keep in mind also that for most of us, our goals, our requirements are not short term; they are long term requirements. So we should not be deviating from a plan which we have set up to sort of achieving our goals in the long run. And the other aspect is, if you want to also, let's say if I have a high equity, then gold can be one way to protect ourselves. So in terms of an asset class. Now there are other opportunities also may come back, but maybe this is for large investors who have sort of deep pockets. You may find distressed assets available. You may have, if you buy a property and you have the capital, this is not a bad time to do it at all. You may get it at sort of rates that you may not have got it in the past. The benefit you have also is of lower interest rates. So that is something which one could look at. We have seen that even in the commercial real estate space, opportunities are available at sort of good yields, okay, which may not have been available in the past. So you may find opportunities even outside the equity markets. Of course, the equity market, I think many scripts have come down to levels which one would not have expected or anticipated. And quality companies have seen a fall in the last leg, because what happens is initially people let off some of the other stuff, but finally they get back to saying that, okay, where do I have profits? And that's where one would have seen maybe HDFC Bank, even some of the companies that benefit from lower oil prices, like and very strong consumer names have sort of fallen, in the current markets. And I think if we are able to, I'll go back to a quotation, a famous one of Warren Buffett, which says, "Be fearful when others are greedy, and be greedy when others are fearful." I think one question that, again, like I said, people have kept coming back and saying, what if the situation gets worse? So again, I sort of try to bring in the charts out here and look back at, where the falls were. The largest one, like I said, has been the 2008 fall. Okay, and you'll find that there have been, some bit of spikes. We should see some spikes sometime soon, even if, you'll see a larger fall. But this time, the initial fall has been reasonably large, so one could want to see. But the point, again, Victoria, that I'm making is, this is a V-shaped sort of recovery, and broadly anywhere that you see it, in a growing economy like India, you'll see that each fall would sort of subsequently result in markets doing well and going back. So this is something which one is saying that you can take comfort from, and one shouldn't be getting really apprehensive about the situation. Okay, where let's say you do have some bit of a leverage scenario, then only you need to get back and see what is it, and if any of you are in that situation, we are sort of happy to help, because in periods like those, it has to be one-on-one, and what is it that we can do. Now, in summary, I'm saying, it's the time we be safe. Clearly, it's the virus is very infectious, and I think social distancing is the norm, and it should be so. It's better to be safe than sorry. Okay, of course, I think one thing I must always say at such times, the WhatsApp university drives us crazy, right? And I feel that negative news just keeps on coming in, and you should be aware that that's how this media works. Okay, and I think we should not we completely miss out on the positive side of things, because actually this particular virus, while it's very infectious, comes in a phase which the fatalities are not high, except for people in sensitive health groups, so and for people who are of a higher age. So especially people come in that group, I think you have to be extra careful. So please be safe and take care of yourself. It's difficult to predict a bottom, like I said. It's almost impossible, I would say. But recoveries are V-shaped, and investing, again, I repeat, investing at lower levels help enhance returns. Disciplined investing has been the key focus for us, and I can tell you at every time, having seen the past falls, every time people will say this time it is different, because I think in 2008, if some of us remember, that was a period when even there was a run on the ICICI Bank. There was a period where people felt that Citibank at a global level will collapse. Warren Buffett had to come in and actually support some of the banks in the US from falling and going bankrupt, and it always feels like, and that's how it is. That's why people fear and markets fall down. Okay, and you need to ensure that you have a strong foundation, and if you have a strong foundation, then you can take advantage of the current opportunities. So I'm coming back to some of the queries that have come in. Okay, one is that as it's evident that the stock market volatility is totally unpredictable and spiraling down day after day. In this unique situation in the history of the stock market, never had before. So any time frame that can be predicted. This query, I think I have already run you through, and data clearly shows that there have been market falls. There have been market falls much larger. It only feels that we've not seen this size in the past. Okay, but we may not have seen the speed. But definitely markets have seen this type of fall, and it always feels there's always panic, but you will find that it sort of comes back. So it's not a thing to be really bothered about. Okay, so I would think that all it does take is to stay back. Like I gave the example of what you do when, say, a house you put up for sale, and the real estate market comes down. You just sleep through that volatile period. I think that's a thing to do. Of course, as right horizons, as professionals, we would look for some of those rallies. We would look for some of those periods to say that, okay, can I de-risk at some time? Can I also keep in mind that we could see a larger market fall, etc. And those are scenarios that we will be looking at on a day-to-day basis. And one thing that we've done in the past is to past 1 year is to actually streamline our systems processes to be able to respond to you much faster and much better. Okay, and the other thing that we've also done is to encourage sort of regular meetings with our team and our clients, and that is something which is tracked by us very, very strongly. Okay, so that is something where you feel a little unnerved, feel free to reach out to our team members. The second question is, I'm a retired person and drawing certain monthly income out of a systematic withdrawal plan. Is this to be stopped till there's some stability in the market, because I'm losing capital with a systematic loss? Now, depends on what you are taking out from. So, if ideally you're taking out from a debt fund, then you need not be bothered if you are withdrawing on a systematic basis, as long as you have sufficient liquidity, to ride through maybe 2 to 3 years, in your debt fund. So if you are sort of withdrawing from an equity fund or a balance fund, okay, then yes, we would need to review it. So if there is a situation like this, please, it's a specific requirement, come back to us. And I think I also, personally support this particular case. So wherever there are situations which are not great, I try to be personally involved and try to help, even if it is from a back end, so that you can be rest assured that the analyst team sort of directly reports into me, and they are sort of the backbone for us to deliver advice to our clients. So they will definitely come back to us. The third query that we have, and before I get to the next query, I have the number on my screen for you to come back with further queries. Okay, so if you have any further queries, please message it. You can also in fact, you can even just call Joe and he can note it down. If you do not have the time. So that is something which so please keep sharing your questions. Okay, the other one is in terms of this the third query. The situation is fatal for small investors. When will it improve? Could you kindly suggest me what we should do as a small investor? I think broadly markets are a leveler. So I think whether you're a small investor or large, like I mentioned, it depends on a little bit. What is your current situation in terms of managing things? Okay, so basically, do you think you have sufficient buffer for a period of time? If you have sufficient buffer in terms of liquidity, etc., including when things are sort of not going well, okay, then I think there's no doubt things will improve. Okay, so that's a good news part of it. Okay, but yes, if things are not going great, then again I'm saying, even if you're a small investor, we are happy to help you and support you. Okay, and do feel free to come back to your relationship person, or if you're unable to reach out, please just mail us at contact us at righthorizons.com, And actually, Rachna looks into that Mail ID or ETE Club at radicalreactions.com. Any of them sort of you come back and we will come back and help and support you and help you assess the situation, because some of these are sort of one-to-one situations. Now the fourth question is, returns have come down by 25%. Should I continue or should I withdraw and invest in the direct market? Okay, so typically at times like these, it does unsettle you. But I can tell you that for most of the customers, from when I see portfolios when they come to me today, okay, who have done stuff on their own, their returns are much worse than say what the mutual funds are, because many a times you end up going and looking at it, looking at television and momentum stocks sort of get covered, in media. The ones which are hyped up is what sort of comes back to you, and that is the reason why you will probably on your own do much worse. Secondly, like I also discussed, that directly investing in stocks, okay, is comes with its pitfalls unless you have good experience in market, okay, and you have managed investments in the long run. So if you're starting now from what it looks like, I don't think it's the right time to withdraw from markets and invest in direct equity. I think SIPs are the best thing ever. Okay, yes, the fall has been unprecedented because the index itself has fallen 30%. You may find in this period that the banking sector, which has the highest weightage, has seen a much larger fall, and so you could see in some of these periods, especially funds which have done well can also come down, because the reason they went up is they were the sectors which actually were trending, and sometimes they also fall more in this period of volatility. But I can assure you that, again, based on my experience, you'll find that in the long run, mutual funds, despite I think the fund management fee and managed funds as a whole, typically deliver much superior value to sort of getting and directly investing in stocks. Again, the first question is coming is this time to invest in the direct market if we have a surplus? At a time like this, I think it's always tempting. And one thing said, if I do it differently, maybe I'll make more money. Actually, many times I tell clients that actually the boring things, investing is very boring. Of course, there are periods when life becomes a little more, interesting, of course, on the negative side. Okay, but ideally we should be, if you go back and look at the SIP returns and you step through the whole period across 10 years, 15 years, okay, I think they would deliver far superior returns, than trying to actively manage markets. Yes, for some investors who are professionals, I think that is something which they do a day in, day out, and that's what will sort of work well for them. But for most common investors, I think it's not the best time to invest in stocks. Okay, with some guidance, yes, one can. Okay, but I still think that at times like this, I even believe that just investing in index is the best thing to do, because you don't know what hit can come from where, and what sector can, even the best sector of the last decade may not be the sector which continues into the next market move, because there are times when things shift and the gears shift, industry sectors also shift. So one has to be a little watchful of that. Okay, so at times like this, I think if you ask me what's the best way to put in money, okay, I think even an index ETF rather than a stock where you want to directly invest in the market is sort of a good thing to put in. But just watch out that what is the premium or hope that sometimes the ETF is running at, and that may sort of take away some of your returns, because if you're running a premium at the low, then you may not be able to get in the exact bottom of the market. And again, when it goes up, if it's trending at a discount, then you may lose a few percentage point return there. and I think I'll take the last question, and we'll sort of request you to come back, continue to mail us with your queries, and encourage you to come back and talk to us and our team. We've told them that again, this is the period where you should actually interact with clients more. I try to personally also keep my communication higher, okay, in periods which are not so good, and we hope that we'll be able to help you through this volatility. The last question is, if you're largely in the debt market, what is the record? I think this is a wonderful place to be. Okay, and when you invest from lows, I can assure you that you will see much higher percentage returns than you would have seen when markets were in a better shape. Of course, if you are in debt markets, then I would suggest still don't assume that you can time the market perfectly well. Put in money on each falls in a phased manner, as well as and keep that restricted to a certain value. But I think the larger one can be you're just doing systematic transfers, and if you need any help on some of this, please feel free to get back to us. But I think if you have debt, both whether it's within move and take a little bit of risk. Of course, like I said, you do your 3x3 matrix, and how much you move into equities should be based on risk profile and your risk appetite. So I thank all of you for attending the call, and please do keep sending your queries in. I personally ensure that I manage a few clients so that I am not out of touch with what's happening around and what clients are thinking of. And like I said before I started the call, I also did talk to a few people, again understanding that is there something specific you would like me to cover. I thank you for your large scale participation, and feel free to reach out to myself or my team, and we are happy to support you. So I wish you that you take it easy. I think sleep over it, and both over all these concerns. Of course, you do your part and be safe. Okay, but I think things will pass. I believe there's a way of nature which automatically sets things right, and things move forward. So all the best, and happy to talk to you as required.
Switch it.